A lot of people are listening to this going, oh, crap, maybe we are in a recession, right? Usually that's in the rearview mirror. Maybe we're entering into a recession. So what do you guys think about this? I mean, this is current news. Jobs are way down. And there's also talk of stagflation. This is a scary word where inflation stays persistent, but then people start losing their income power because they're losing their jobs. How does this affect us?
I think if you own enough real estate, it doesn't matter, right? Like, I think a lot of our tenants have jobs. Some of our tenants don't have jobs. They're on fixed income. Some of my tenants are big businesses and they employ people. So yes, there's an impact, but I've been investing for 20 years. And in those 20 years, jobs have come and go and industries have come and go. And the truth is, if you own enough real estate and you have enough tenants, you're going to be okay. Like, I don't care. I mean, on an individual case, I care. Like, I want people who want to have jobs to have jobs and prosper and build their wealth and earn an income. But I don't actually see it affecting and impacting rents and tenants and real estate all that much. I think it's a bunch of hype. Tenants usually find a way to pay. They either have a job, they have fixed income, they get another job. That's my 2 cents.
Government prints money,
Yeah.
gives them money. Mitch, what do you think?
Well, yeah, I think I do agree with you, Gabe, and I understand what you're saying. And I think that if you're positioned correctly in real estate, like you said, if you own more, the more real estate you own, the less risk I think you have. Because like we talked about prior, it's like, you have a duplex, 50% goes vacant, or half goes vacant is 50%. You own a lot of units, you're sort of insulated from that. I think where I could see this affecting us is I do think that we're going to see a rate reduction. I hate to predict things, but I do. The last, Fed meeting with Jerome Powell, he talked about sort of this weird scenario where inflation was still set at 2.7. I think their target's at 2, but he also on the other end talked about jobs. Yeah.
Give us a prediction. Okay. The Fed, they're next week, Fed's coming out. They're going to drop it a quarter point, a half a point.
I think it's a quarter. If I had to predict, I'd say a quarter. I'd say 25 basis points. 25 basis points.
Travis, same thing?
Yeah.
Well, yeah, but I've said this before, a lot of people also mistake the Fed rate for interest rates that correlate to their investment property. And most of that's oftentimes tied to the bond market.
But there's a correlation, though. It's not direct.
I had a lender tell me yesterday, because we were on a phone, because I'm trying to buy this big triple net commercial property. I had a lender tell me, hey, the rate is probably going to be 6.75%. This is on a commercial $5 million asset. He said, if the Fed drops rates a quarter point, it's going to be 6.5%. If they drop a half a point, it'll probably be 6.25%. So even though it's not related, he told me, this was yesterday on the phone, said, if it drops a quarter point, your rate's going to be a quarter point less. If it's a half a point, it's going to be half a point less.
Well, he's a dirty liar. No, I'm joking, but I do think they are correlated. I think the treasuries, the 10-year, the 5-year, have already priced in the expectation that the Feds are going to lower, and I think that's why I think you're already seeing rates reacting to what is probably most likely going to happen after the Fed meeting.
I'd say 25 basis points, but I think that the Fed has a hard job right now because they still want to lower inflation. And that means keeping rates high. But on the other end, we're seeing bad jobs reports that are discouraging that could push us potentially into a recession. I don't know. Maybe we're there already. But so the Fed's kind of trapped. I do think they're going to lean towards giving the economy some juice and making debt cost less because of the jobs report. So anyway, I'm going to go back and I'll say 25 basis points. That does affect us. It makes cost of debt cheaper, but it'll make real estate prices more expensive potentially. So we could also see an effect all the way from single family to commercial because people have been waiting on the sidelines for interest rates to drop. That first drop could inspire some new buyers to come in.
I also think when I hear jobs report, I feel like it's a way for non-investors, wannabe investors to be like, well, it's kind of risky to buy. It's risky to buy real estate right now because everybody's going to be out of a job and no one's going to be able to pay rent. Therefore, I'm not going to invest in real estate. And I think it's fucking crazy. It's like the old adage of the best time to buy real estate was 20 years ago and the next best time is today. A lot of people let these outside things, and not that they don't impact real estate, they absolutely do. Things like jobs and interest rates and prices and all these socioeconomic things, so many things impact it in some ways. but I watch a lot of people allow these headlines and these reports to limit them from going out there and building wealth, creating wealth, and ultimately creating freedom. So they see a headline that goes, oh my gosh, the jobs report came out. There's going to be
supports the narrative.
Yeah, 1 million less jobs. Like there's no way I would invest in real estate because who's going to pay rent? Meanwhile, there's millions of renters in the United States and millions more throughout the entire world that are paying rent to live somewhere. And housing is always going to be a need. On the commercial side, most businesses are going to need a physical space to do business, especially like large manufacturing and that type of industry.
Well, yeah, I think there's puts and takes to everything. And I think the puts here are that rates come down, cost of capital comes down. You can cash flow properties easier. And also with rates coming down, cap rates go down on commercial assets, values go up. So there's good things, right, that come around. Now, the argument to that could be, well, if your tenants don't have jobs and they can't pay you rent, well, that's a big problem too. But then I also go back to sort of this new government philosophy over the last decade or two, whereas when there's pain, especially associated with a basic need like food and housing, the government's going to step in and save people. The government, that's the new philosophy. Oh shit, there's an issue, there's the pandemic, or there's a housing crisis. Okay, government swoop in, print a bunch of money, right? Hand it all out to people, save them, which then has ripple effect, macroeconomic ripple effect. So yeah.
But this happened during COVID, like 2020, I know the news was reporting 50%, like there's a rent, moratorium, or eviction moratorium. You couldn't kick people out. People weren't paying rent. There's all these reports that people weren't paying rent. Meanwhile, almost everybody I knew was still collecting rent. My portfolio, I think, was still 98% paid rent. The ones that weren't were already tenants that had issues paying rent in the past. And my property managers, going back to the free money, actually were able to help get assistance for those tenants that were financially struggling. And so at the end of the day, fast forward 2022, at the end of the day, all those tenants ended up paying rent, whether by themselves or through some kind of rental assistance program.
Well, the other thing too is this is a jobs report. I believe it's how many we added, right? We just added less. So it's not necessarily that we're just losing. Am I reading that wrong? We're not, in other words, you take.
I didn't read the report.
Travis came up with the data, so I don't know where he's getting that. I came up
with the data.
I thought this was your. I thought this was your own research or something.
Did your intern gather this data? Where'd you get this?
Dumbass Dylan. No, you're right, Mitch. The jobs report was 911,000 lower. Again, this is through March. This is definitely in the review mirror. 22,000 jobs were added.
Okay, so that's what I'm saying is the amount of jobs being added has slowed down. We're still adding jobs. Now, could that mean that people are going unemployed at a higher rate? For sure, but I think it would take millions and millions and millions of jobs lost, literally lost, and they're not getting them back to affect our tenants. So I think it's a less of an argument on whether our tenants are losing jobs and can't pay rent, and I think it's more of how do we, I never like to predict the market or play the market in that way, but I like to take advantage of what happens in the market. So for example, if we see 25 basis points or 50 basis points on the next reduction, we own real estate. So we have the option to go back to the bank and refinance on several assets potentially, right? And pull out tax-free money. The other thing too is if we get, multiple bad jobs reports and we go to a recession and there's fear in the market, that could be fear across equities. It could be fear across real estate. That could open up the market for more deals. People who own real estate at 65 years old thinking the market's going to crash, we might see supply come online. So it's I think being aware of these macro events, but being realistic, we'd have to lose millions and millions of jobs for it to affect our real estate in a tangible way as far as today operationally. But being aware of this and understanding, hey, there might be opportunities coming because we get a lower cost of capital, or there might be fear in the market because we're in a recession. If they say we're in a recession, we can see a lot more sellers go, you know what, screw it. I got equity in this thing. I want to retire. I don't want to risk it. Let's go sell. That could be a thing as well. We could see an increase in supply. So I don't know. I don't think it's going to affect our, the fact that we added less jobs, I don't think it's going to affect our actual operations today.
Well, also there's the big, beautiful bill. There's even more tax incentives to owning real estate. You can take 100% bonus depreciation, and people forget that taxes are a huge expense to life. And if you can then leverage tax benefits in real estate, which you can in equities and other things, then I think you're going to win. And also, I think, inflation was at 8%. Yeah, now it's down to 2.6, whatever. The cost of shit's still a lot higher. And if you already own assets, inflation helps drive the values up. And if rates do go down, you're going to get cap rate compression. Values are going to go up. To your point, Mitch, now my property is actually worth more. Now maybe I can take out different debt, maybe at a little bit better interest rate, but my values are higher because I got some cap rate compression there.
All I hear you guys saying is the same thing that I've always said, that you guys always say, is that there is always opportunity in real estate.
An imperfect market, for sure.
Yeah. It's an imperfect market, but there's always opportunities. Like every action has a reaction, right? Like rates go up, there's opportunities. Rates go down, there's opportunities. Like in the meantime, like I don't chase headlines. I'm not worried about all these things, that impact. I shouldn't say I don't care. I don't let it impact my ability to live my life on my terms, right? So like real estate, there will always be opportunities, whether interest rates go up or down, jobs go up and down. There's an opportunity to buy, there's an opportunity to be creative. And in the meantime, like instead of watching the news, I'm going to focus on the things that are important to me. I'm going to spend time with my wife, my 2 kids. I'm going to try to get jacked in the gym. I'm going to grow a fucking awesome mullet. And
let's see it. Let's see the mullet.
Yeah, travel the world, live my life on my terms.
It looks great.
Party in the back.
Great.
That's right. That's right.
Yeah, I agree. I think that with real estate, it's an imperfect market. And we often say deals are made, not necessarily found. Seller financing, you can negotiate with banks. By the way, people forget that. Like we're every single property we're refinancing now or we're buying, we're saying we want at least 2 years of interest only. That allows us to have time to enforce our value add plan, improve the net operating income. So there's so many data points that make a deal, and you control that if you know what the hell you're doing. So join the Elite Mastermind, come learn these data points, learn how to underwrite these properties, and go buy real estate, because you're right. Every day is a good day to buy real estate, the right real estate. Is it a bad investment? Is it a good investment? Robert Kiyosaki says, are you a good investor? And I think we've proven that we hold our own there. So let's do it.
All right, guys, I got to run. I got to cut this one short. I have a call with the broker about this property that I'm super excited about, and I will update the Elite group and you guys as I dig into this deal that I'm working on.